Hello, and this is Global Business Insights, where we look deeper at the headlines from a business perspective. Austria's economic minister Martin Kocher has been nominated as the next central bank president as part of wider leadership reshuffle in which three of the four board members of the Austrian central bank are to be replaced over the next 12 months. Global stocks are stabilizing following the sell-off on Monday that saw equities suffer their worst session in nearly 2 years. Technology stocks are leading the charge, with the Nasdaq Composite up 1.6% at market open on Wall Street. Nvidia, which has struggled of late, climbed 3.8%. Earnings releases continue to be a mixed bag as economists continue to push back that the panic we saw on Monday was an overreaction, adding that a soft landing is still on the table. Maersk, for example, says it does not see a recession in the near term. As confidence returns to the housing market in the UK, house prices rose 0.8% in July after 3 months of relatively flat growth. And in the US, Kamala Harris overtakes former President Trump in the polls and picks Tim Walz, Minnesota's governor and a former high school teacher, as her running mate. Still in the US, mortgage applications released by the Mortgage Bankers Association went up by 6.9% compared to a 3.9% drop the previous week. The interest rate for the most popular US home loan fell last week to its lowest level in 15 months after the Federal Reserve signaled it could start cutting its policy rate in September. China's imports grew the most in 3 months as exports growth slowed. Imports were up 0.2% in July in dollar terms from a year earlier, significantly more than an expected 3.2% gain, while exports expanded 7%, below a forecast of 9.5%, also leaving a trade surplus of $84.65 billion for the month. Elon Musk has accused the advertising group's initiative called the Global Alliance for Responsible Media of coordinating a pause in advertising after Musk bought Twitter for $44 billion in late 2022. Kenya's central bank surprised financial markets by cutting its benchmark interest rate for the first time since early 2020, providing some respite to consumers frustrated by the high cost of living. Governor Kamala Harris said the Monetary Policy Committee lowered the key rate to 12.75% from 13%. Welcome back. Oil prices attempting a rebound today as the risk mood broadly improved. Brent crude up close to 3% due to the heightened geopolitical tensions in the Middle East and supply concerns from countries like Venezuela and Libya. Oil prices also climbed after the U.S. Energy Information Administration reported a surprise crude inventory draw, reversing an earlier decline in prices caused by concerns about a recession and uncertain demand growth. The latest US EIA data just out showed US inventory was down 3.7 million barrels from the previous week, and that is supporting the rebound. Earlier, the American Petroleum Institute reported an estimated build of 180,000 barrels for the week to August 2nd, surprising markets and pressuring oil prices. For oil markets, it's still a lot of volatility and uncertainty, driven by fear and conflicting narratives on the economic outlook, complicated by geopolitical tensions potentially set to escalate. Also today, we did get a slew of earnings releases and announcements. Super microcomputer shares nosedived 11% as the server maker's margin performance offset news of a 10-for-1 stock split. Novo Nordisk stock also fell as the Ozempic maker's profit and sales lagged expectations as it struggles to build out capacity for its weight loss drugs. Disney has raised its streaming fees for Hulu, Disney Plus, and ESPN. Streaming bundles become more expensive for those who want an expansive playlist and options. With the mood on sensitivity to prices, let's see the impact higher fees will have on future subscriptions. Walt Disney reported quarterly results that beat analyst expectations thanks to strong performance at its streaming unit. But despite showing its first quarterly profit in its streaming business, the experience unit, which includes the theme parks, showed a drop in operating income. The media giant earned $1.39 per share on revenue of $23.16 billion, better than expected $1.19 per share on revenue of $23.07 billion. Shopify said the total volume of merchandise sold on the platform spiked 22% during the quarter to $67.2 billion, easily topping estimates. Shopify sells advertising and payment processing tools and shop software for merchants who run online businesses. For Airbnb, weaker than expected revenue guidance hurt shares as it saw Q3 revenue in a range of $3.67 billion to $3.73 billion, less than $3.84 billion earlier estimated. Revenue for the quarter ending in June was $2.75 billion, up 10.6% from the same period in 2023 and above analyst estimates of $2.74 billion. And the company's guidance of $2.68 billion to $2.74 billion. But earnings of 86 cents a share were below the estimate for 91 cents a share and down from 98 cents a share a year ago. Uber reported 16% year-over-year revenue growth, posting $10.7 billion in revenue for its second quarter against estimates of $10.58. Uber reported 16% year-over-year revenue growth, posting $10.7 billion in revenue for its second quarter against estimates of $10.58 billion. It was an all-round earnings beat for Uber, as it also reported earnings of $0.47 per share compared to an expected $0.39 per share. The chief executive of Maersk, Vincent Clerc, says it is not seeing signs of a U.S. recession as freight demand remains robust. Maersk says Chinese exports have been the engine behind strong container volumes, which they see continuing into coming quarters. The narrative is conflicting on whether we could be seeing early signs of a future recession. It's too early to suggest a hard landing is inevitable, but while a future recession is not imminent, it cannot be ruled out, especially as some indicators like rising unemployment are waving red flags. Goldman Sachs economists also raised the probability of a U.S. recession in the next year to 25% from 15%, though they cautioned the risk is limited. It is unlikely, in my view, that the growing cry calling for an emergency interest rate decrease before the Fed's September policy meeting or for 50 basis points rate cuts will get much attention. The next big opportunity to signal next steps and views on the economy could be at the chairman Jerome Powell's speech at the Jackson Hole on August 22nd to 24th. Markets are considering a U.S. judge ruling that Google illegally monopolizes online search and related advertising. Google owner Alphabet's inevitable appeal means that the legal process is likely to take a while to resolve, as the government wants some form of structural relief. That means Google may be pushed to break into smaller chunks. The argument might be that the actual search engine should be spun off into a separate business from YouTube. That was the $1.65 billion acquisition in 2006. Or Android, that's a firm bought for $50 million. That was in 2005, which now runs on the majority of smartphones. Also, Apple's lucrative deal with Google could be under threat. Google pays Apple $20 billion annually, or about 36% of what it earns from search advertising made through the Safari browser. That's for the privilege of making its search engine a default on Apple devices. Undoing this deal could mean a 4 to 6% hit to Apple's profit, and we'll see how that develops. The pact runs until at least September 2026, and Apple has the right to unilaterally extend it for another 2 years. Analysts see a most likely outcome to stop payments for default placement, instead requiring Apple to proactively prompt users to select their search engine rather than setting a default and allowing consumers to make changes in settings. The bottom line is that regulatory headwinds are well arrayed against bigger tech players, and the regulators want to see competitive strength of the likes of Google weakened to support better fairness in competition and nurture the smaller players. Of course, the big tech sector are not going down without a fight, and an election year in the US, I suspect, plays to their advantage. Kenya Central Bank's Monetary Policy Committee cut its main interest rate by a quarter percentage point to 12.75%. Kenyan President William Ruto is acting to ease the worst crisis of his near 2-year presidency as protests over tax hikes turned violent, forcing him to scrap deeply unpopular tax increases meant to reduce public debt, which are standing at about $78 billion. The Court of Appeal also annulled the controversial tax hikes that were adopted in 2023. Ruto has sacked most of his cabinet in July and aims to form a national unity government. The annual inflation rate in Kenya was down to 4.3% in July 2024, also the softest since September 2020, and down from 4.6% in June, and below the 5% midpoint of the central bank's target range. That means a very strong and positive real interest rate of 12.75 minus 4.3, that is plus 8.45%, presenting a compelling case for investors. While Nigerians are also protesting the high cost of living, inflation accelerated further to 34.19 in June 2024. So the Nigerian Central Bank is in a far different position. We are seeing high negative real rates, that's 26.75 minus 34.19, that is minus 7.44. On August 15, we will get July inflation, which some have said may still be inching up, given pressure on the naira as funding of FX markets still remains somewhat challenged. The big lesson from Kenya's economy is that the handshake between fiscal and monetary levers have to happen properly to bring inflation in Nigeria down. Still on Nigeria, the Central Bank of Nigeria granted an approval for financial accommodation to support the proposed merger between Unity Bank PLC and Providence Bank Limited, a move designed to bolster the stability of Nigeria's financial system and avert potential systemic risks. Also, Nigeria's revenue share, that is dividend from Nigeria Liquefied Natural Gas NLNG Limited, has plummeted by 43% due to persistent gas supply challenges. Again, oil and gas sector facing headwinds in Nigeria. European markets were mostly positive, tracking global markets shaking off the recent sell-off. The rebound in Wall Street, which yesterday broke a 3-day stretch of losses, is also helping to lift global sentiment. But we also gather that all the 3 main indices in the US, including the Russell 2000, have given up most of the gains that they had earlier in the day. All 4 indices, S&P 500, Dow 30, NASDAQ, and Russell 2000, all in the red. Well, that's it from me on Global Business Insights. This is Bode Oshasami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Again, thank you so very much for watching. Bye-bye.